Joining us now is Mike McGlone. He's a senior commodities strategist and a Bitcoin expert for Bloomberg Intelligence, and Heather Long. She's the chief economist at Navy Federal Credit Union. Mike, I want to start with you. Before we get to the what, let's talk about the why. What started all of this? How did this get rolling? What were the big factors?
The key fact for Bitcoin is there's unlimited supply of cryptocurrencies. Bitcoin's one, and there's millions of them. What happened last week is strategy. Michael Saylor, who said he would never sell, has started to sell a little bit. Some of us have just been waiting for this forever. I know Michael Saylor. I met him years ago, and he just got too long. An asset he probably should be buying low and selling high. He just bought higher. But the key theme is, you were talking about that game earlier. There's a game on all the time in cryptos, and they're trading right now. The key thing to remember about cryptos is everything's getting tokenized. And the most significant tokens are the US dollar. And the number one token that tracks the US dollar is Tether. And right now, Tether is on track to potentially flipping Ethereum. Ethereum's number two. By flipping, that's a good nomenclature in cryptos when you surpass assets under management of another cryptocurrency. And it's a key trend is these tokens, or Tether, has been flipping and everything. As we wake up Monday morning, might be the number two cryptocurrency after Bitcoin. But the bottom line is there's unlimited supply. There's starting to be a purge. It looks like the purge just got started. And the key thing to remember is Bitcoin's a good leading indicator for risk assets, and stock market's starting to follow.
And Heather, can you say why we started to see some of these big tech sell-offs? I mean, I know there was jobs numbers, there was some Berkshire Hathaway sell-offs of some similar properties. Why did this start to, again, get the ball rolling?
Well, to me, it seemed a little bit overdue. I mean, some of those rallies in the last couple of weeks have just needed to hit the brakes. The one thing that really jumped out at me in the end of the week, other than the jobs data, which I'm well known for following closely, was the, what happened in South Korea. Also seemed to be a bit of a canary in the coal mine, people pulling back on trades there and starting to reassess and frankly, take their gains.
Heather, you mentioned the jobs numbers and your eagerness to follow those month after month after month. I think a lot of folks gobsmacked when they saw that beat yesterday. It was something that was startling, just the magnitude of that beat. What do you make of it? What does it say about the labor market as we kind of talk about the agita in the markets more broadly? It didn't take long before we saw chief economist after chief economist after chief economist revising calls for what the Fed is going to do next. Indeed, it does seem like a hike is all but inevitable.
Yeah, I mean, to me, the hiring recession is over. The magnitude, not just of the May number, but of the past 3 months, is just incredible. 188,000 average a month the past 3 months. That would have been a good number back in 2019, let alone sitting here in 2026. When the break-even rate for the jobs is probably somewhere in the 30 to 50,000 range. I think it was really telling as well, the breadth of the gains in the past 3 months. This is no longer just a healthcare story. And even if you think hospitality got boosted by the World Cup effect of more hiring in restaurant and bars, it's harder to brush off the rebound in transport and warehouse or in retail or even in construction as some sort of one-time effect. Another really good indicator was the Black unemployment rate. Black unemployment rate hit its lowest level in a year. These sort of trends seem a lot more sustainable and long-lasting. The one Achilles heel is that wage growth number, the lowest in 5 years. 3.4%, probably going to get a 4% CPI print next week. That's the pain point for the economy, and that's the big question mark. I call it an E-shaped economy now. Can the middle class hold on? I know we were joking about Knicks tickets, but can they even keep spending the same amount at Costco through the end of the year?
Yes, a very good point. Mike McGlone, you mentioned Bitcoin as kind of a leading indicator for risk assets, and I wonder if you could situate that in this environment we're in right now, where we're just days away from a SpaceX IPO. We're talking about an OpenAI IPO, an Anthropic IPO, just a ton of money flowing to the markets. And I'm curious what that means for cryptocurrency. We've seen it as this kind of prominent risk asset for so long here. How much do you think these outflows are going to continue now that we see these AI companies and SpaceX kind of coming to the public markets?
David, I think you nailed it. That's the key theme is cryptocurrencies and precious metals have no income, no earnings, no revenue, and the earnings from the stock market are off the charts. So to me, it's just one of those things is what money managers are doing. They're realizing cryptocurrencies have unlimited supply. They're duds, so they're selling every rally. You sell the duds and you buy the studs. The studs is the stock market. Stock market's the only game in town. Sure, we've had a little bit of a healthy correction, but that's the key thing I have from a commodity standpoint. You're going to see continued selling of cryptocurrencies, most notably Bitcoin, because there's a better game now. And we realize, and most of it's just speculation, and that speculation is just getting purged. I think it's the beginning of a purge of, there's millions of cryptos that track nothing. We get rid of those, and at some point we'll find a bottom. Looks like we're far from that bottom, though.
Mike, you made a call that Bitcoin was going to drop below 50,000 back in February. I'm looking at it now. It's hovering around 60. Do you still stand by that? Has your call changed? And then you also put together this research explaining that you think 2026 is going to be the year of pump and dump contagions. That's not a phrase I thought I would say, but can you explain to us what you mean by that?
First of all, my call starting last year was for Bitcoin when it got above 100,000 to lose a zero to go back to 10,000. I've made a similar call in 2018 when it was around 10,000, and I got about 70% right. But the key theme is it's just starting. We had the best back test in history. We had ETFs jump on, which means mainstream, and President Trump pumped it, and now it's dumping. But the key thing is Bitcoin pumped and begin the year, and now it's dumping. Natural gas in the U.S. pumped and begin the year, now it's dumping. Corn was up a lot, and now it's down in the year. And just what happened is silver was up 60% in begin the year, now it's down in the year. You see that trend? My theme is, I'm very concerned, is we have never seen surging volatility in gold and crude oil without it trickling up to the stock market. Bitcoins are collapsing. It just looks like the next big trade is crude oil is going to follow natural gas on the way down and potentially the stock market to follow Bitcoin.
We had a number of cabinet officials on Capitol Hill this week testifying before various committees, Secretary Scott Bessent among them, and he was asked about the pressure that energy prices are placing on consumers, picking up on what you said just a moment ago, Heather, about the real pressure a lot of people in America face right now when it comes to cost of living. Something he and the White House have floated now or have asked for is repealing this federal gas tax. Let's take a listen to what the Treasury Secretary had to say.
We have asked Congress to move to eliminate the gas tax. That is done through statute.
You have moved that. So you're in favor of eliminating the gas tax.
We have asked for that.
So we can join bipartisanly today because you're in favor to eliminate the gas tax.
Again, the White House has asked for it, sir.
Heather Long, let me turn to you. I'm curious sort of how manifest the pressures from this energy crunch were in that jobs report on Friday. And I know that you are somebody who can give us the straight dope here on what removing that federal gas tax would actually mean for consumers, how much of a panacea that would be for those who are suffering because prices continue to creep higher.
Yeah, I mean, politically, it's probably their best option because there's not a lot that you can do in the short term to give relief on gas. But obviously, from a budget perspective and from a practicality perspective, it's not a good idea. I've heard on your show several budget experts come on and just totally say they've given an F grade in terms of how to solve this. Obviously, it creates much longer holes down the line for we need to fund our transportation, and that's the way we do it, right or wrong, in the United States. I will say, so we have 15 million members at Navy Federal Credit Union. We're monitoring very closely the credit cards and debit card spending data. What I can tell you is two things. Number one, it's been surprisingly resilient. But number two, there is some pullback, particularly from folks earning about $50,000 or less. You can see the pain pressures that they are spending less in inflation-adjusted terms than they did in 2019. And what is interesting to me is the two areas we start to see some real pullback on. One is home improvement spending. That's discretionary, not super surprising. But the other one that worries me is healthcare spending. We've seen some pullback, early signs of pullback there. Are people not going to the doctor? That creates bigger problems for society and even for the workplace if people aren't getting their needs taken care of.
Mike, from a larger perspective, if you're not you and you're an average person watching these markets, watching us talk about all these different factors and what they're doing at the moment, how worried should you be? Should the average consumer, the average investor be concerned about an AI bubble, about the exposure of some of these indexes to these big companies as they go to IPO? Should people be worried, especially people my parents' age who may not have the kind of duration they need to recover if something goes badly?
Well, I'm glad you went there because being in Florida, you see a lot of more retired people that are way overexposed to risk assets in the stock market. And they can't help it. It's the best rally we've had in 100 years. We have more exposure of wealth to the stock market than any time in history. Cryptocurrencies are starting to decline and warn you. Gold's big rally last year was warning us. So I don't think people should be worried. They should adjust themselves accordingly. Don't be overweight a risk asset that is the most expensive on the planet. And the key thing that happened this week is that U.S. Treasury long bond at 5%. To me, that's just too attractive for a stock market and for gold and for cryptos. And I think that's responsible investors should just be careful being long an asset that everybody else is long and look it over just good old U.S. Treasuries.